Hello, I'm Bob Goulder, a contributing editor with Tax Notes. As everyone knows, Election Day is just around the corner. So today we're going to be discussing an issue that perhaps doesn't get as much attention as it deserves: taxation and the economy. To do that, I've enlisted the assistance of some venerable colleagues of mine. I'll be joined by Martin Sullivan, chief economist with Tax Notes, and Joe Thorndike, contributing editor with Tax Notes. Marty and Joe, thank you for joining us.
Thanks for having us.
Great to be here.
Now, in a minute or so, I want to dig into some of the details of the candidates' various tax proposals. But before we do that, I want to get to more of a preliminary issue, and it's the realization that tax legislation never seems to happen in a vacuum. It's always a reflection of the context around it, and that implies the pandemic that's going on and the recession and the need for stimulus. So my initial question today, Marty, is for you. I'd like to make sense of the interconnection between stimulus, whether we get more of it or whether we don't, and the case for a big tax bill, because I can't figure out if they're complementary or in conflict with one another.
Thanks for the question, Bob. As you say, tax policy is not made in a vacuum, and a lot of times these presidential plans are sort of crafted in a vacuum, not taking into account, well, they might be crafted 6 or 8 months in advance of the election, and they can't take account of the economic and political conditions on the ground. What I'm thinking about as I'm always trying to predict the future, never doing such a good job, but what I'm trying to do is whatever the next president is going to start trying to do in January and February is going to depend upon the economic environment. So is the recession still raging, or are we on the road to recovery? And I won't be mealy-mouthed here. I think I've reviewed the evidence that's out there. Of course, there's a lot of uncertainty, but it looks like we're still going to be in pretty deep trouble in January, February. And so let's just say we probably will not be in rosy economic times 3 months from now. The other thing to be concerned about, as you mentioned, is the stimulus. If we don't have a stimulus, there's a lot of undone business as compared to if we do have a stimulus before the election. So and right now, not to be mealy-mouthed, we're probably not going to have a stimulus, which means whoever the president is will have to roll into his plan the undone stimulus work. So that really absolutely changes whatever they might have on their policy paper. And thirdly, the political situation matters. And of course, we all are going, is Trump going to win or is Biden going to win? But the other major factor, which actually, the more I think about it, the more it dominates my thinking, is whether or not the Senate will swing House to Republicans or Democrats. Because, if you sit down with a piece of paper like I have, I count my fingers, so I have to do things like this. I counted 8 different possible outcomes of how the election will turn out in terms of the mix of government. Of course, the Democrats could sweep, the Republicans could sweep, and there's 6 permutations of mixed government where the House, the Senate, at least one part of the House or the Senate of the White House belongs to the other party. Now, if we're in that intermediate stage, and right now the most likely outcome looks like it would be Biden wins and the Republicans retain the Senate, well, guess what? We're in gridlock. And frankly, I don't think there's going to be there'll be a monumental difference on so many other counts. But as far as moving tax policy forward, we're still being gridlock. On the other hand, and lately, based on what I've been seeing from the bookies in UK and from some of the polling data, is it's like 50-50 the Senate could swing. Now, I'm not trying to predict anything, but let's just say it's 50-50. But if the Senate swings Democrat and and Biden wins, we obviously are going to have an enormously different situation where the Democrats are going to basically get to do everything they want. and we'll have a very different tax policy, and it will be very similar to the American Recovery and Reinvestment Act of 2009 in terms of its character, because it will be a stimulus bill wrapped into everything that Democrats want bill. The only other thing I will also mention is if we do not have a stimulus before the election, we are likely to have a bill more quickly than if we have a big stimulus now. There's no big rush to pass the Biden or the Trump program after the election. But if there isn't, we can expect something fairly quickly. And the AARA, that is the Recovery Act in 2009, passed in mid-February. So I'd just like to set those broad brushstroke parameters, what the environment is before we worry about the details.
Well, thanks, Marty. Joe, you had a chance to hear Marty's comments. If you're like me, you're thinking right now that maybe we should be envious of a parliamentary system, because you're always going to get, well, not always, you're most often going to have divided government, and that should not be a deal killer for progress in the form of tax or economic stimulus. Is divided government that much of a buzzkill?
Well, I mean, I think a recent history would suggest that it's there's room for compromise on some things, and let's assume for a minute that Marty's right and that we end up with a Republican Senate. It's possible to imagine some room for compromise around stimulus, which I think would be the first order of business, because like Marty, I am not optimistic about the chances for a COVID stimulus package now before the election, or certainly not after the election, really, regardless of how that election turns out, unless it's the unusual possibility of a Republican sweep, which seems unlikely given the current polls. I think that I'm not especially optimistic even about stimulus with divided government, if that's what we end up with. Unlike Marty, I'm a little less certain. I think that the most likely outcome is divided government. I guess maybe I'm naive, but I do really I tend to think that the polls are more often right than wrong, and it's too early to know where the polls will land. But at this point, I think my guess would be that the most likely outcome is actually a Democratic sweep. I don't know if I'll say that in 2.5 weeks or whatever the election is, but even a Democratic sweep, though, I think we should be careful about what we're expecting, because we talk about divided government like the Democrats are a unified party. But what is that old line about it? I'm not a member of any organized party. I'm a Democrat. Wasn't that?
There's Will Rogers, right?
Will Rogers, that old line about the Democrats. Well, I mean, the Democrats, if they were to pull off this crazy feat and win a majority in the Senate, they're going to be a pretty diverse party. They're going to be, Senator Manchin, Senator Sinema, maybe senators from Montana and other less than bright blue states. It's not clear to me what they're going to be willing to vote for. I mean, certainly they'd be willing to vote for a good, nice, happy stimulus bill, but it's not going to be, a Bernie Sanders stimulus bill.
Let me reiterate what Joe's saying, even digging further back in history. And I'm not that old. I read about it in the book. In 1993, when President Clinton came into office, again, it wasn't an anti-recession measure. It was deficit reduction was the theme at the time. And all through the campaign, Mr. Clinton said 36% rate, up from what was then a 34% rate. And the Democratic chair of the Ways and Means Committee, Dan Rostenkowski, said, let's go for 35. And that was it. So, and that's why we have 35, at least we had 35 up until a few years ago. So, and I can see Richie Neal, who's I think on the more conservative end of, or more moderate end of the Democratic spectrum, trying to cut more business-oriented deals. But again, it's going to be a balance. It's going to be a balancing act. And again, look at 2009. There was Joe, there were the same arguments back then, but you know,
Yeah.
they're not going to not do anything. They're going to do something
No.
big, but not big enough to satisfy the left-hand side of the party.
Yeah, and actually, I think where this will get even more interesting is when we start talking about what they'll do around actual tax policy, like tax
Yeah.
reform. That's when those distinctions are really going to start to matter, because most people can get on board for stimulus of varying sizes, but when it starts to become questions of like, and I'm sure we'll turn to this in a minute, what are we going to do with the corporate tax rate? Well, then you'll start to see the divisions really open up.
Yeah.
Well, speaking of those details, let's drill down a bit on some of the nuance in the Biden tax plan. Let's start on the individual side, and then we'll talk later about some of the business and corporate provisions. The first thing that jumps out of the box is his headline rate on the top income earners. Currently, it's 37%. Biden has proposed raising it to 39.6%. And when I mention this to friends at a cocktail party or a virtual cocktail party, they say, what is up with 39.6%? Why the decimals? Have we declared war on whole numbers? What explains this? So, and I usually say it's just a symbolic dismantling of TCJA. So, Marty, let's start with you. Raising the rate, the top rate on the top income earners from 37 to 39.6, is that going to do anything about income inequality, or is that not even the point? Is the point to do any little thing to make the tax code that much more progressive?
Bob, I just want to tell you first, it's very scientific how we got to 39.6, okay? The rate used to be 36%, and they said, I don't know, what do you think? What should we do? Well, let's raise it by 10%. Why 10%? Because I got 10 fingers on my hand. And so 10% of 36 is 3.6. Now follow the math, Bob. 36.36 is 39.6. So that's how we got there. Anyway.
I'll get my abacus. Thank you.
Also, it happens to conveniently be below 40, which is 4 times the number of fingers I have in my hand. So that sounds a lot better than 40.
What's wrong with 40? If you're serious about progressivity and you're serious about closing the income gap, which are stated goals of everybody in the Democratic Party, why wouldn't you just come out and say 40%? I mean, we're talking about minutia here, but
when I went to the Home Depot the other day to buy a new electric drill, it was $49.99, Bob. It wasn't 50. Some reason it sounds better. It's just salesmanship, not economics.
Joe, you agree? Salesmanship?
I do agree. And I mean, I think you got to look at the candidate you're talking about here. I mean, Joe Biden is not a guy who is going to rock the boat too much, right? I mean, his whole, I mean, it's actually kind of masterful the way he's pulled this off, right? He's a guy who manages to look moderate even while cozying up to the AOC side of the party, and he manages to make it work. I don't think I've ever seen anybody pull that off the way that he has. So,
Joe and Bob, to anticipate another question is, the cosmetics around the 39.6 rate. The reason we're going to have the reduction in the what I call the P's and PEP provisions, which are the phase out of the deductions, is they could have just raised the rate, but they didn't want to raise the rate because it's too visible. So they did a backdoor rate increase by doing P's and PEP. Again, that was instituted in 92 or 97. Again, these are backdoor increases. So I actually think the 36 to 39.6 is not the biggest part of it. It's the, which is the other topic I'm sure we're going to get to, the capital gains rates increase.
Yeah, we'll get to that in a minute. Before we get to capital gains, though, I wanted to pick your gentlemen's brains about payroll taxes, because these are taxes, people pay a lot of payroll taxes. They don't get all the attention that income taxes get. But there's a proposal here, and we're talking about the 12.4% Social Security tax. And it's split between an employer contribution and employee contribution. And it phases out at a certain income threshold. Currently around $137,000 a year of wage income. Now, what Biden would do is he would keep it in place and he would keep the phase out, but then he would have it spring back to life when wages get around, I think it's $400,000 a year, which creates, payroll taxes at the low end, payroll taxes at the high end, and what's known as a donut hole in the middle. But is this the right policy? Marty, please, you're an economist, illuminate me, because when I see a tax like this that applies at the low end and the high end, my instinct is that the people making the laws cannot make up their mind whether they want this to be a regressive tax or a progressive tax. So as a result, it's a little bit of both.
Well, I'm very interested to hear what Joe has to say about it. But the basically, he's throwing the kitchen sink at everybody making over $400,000. And so you have five different, actually six if you want to really count them, 6 different proposals, all of which hit incomes over 400,000. Now, what we public finance gurus like to say is you don't need every provision of the code to be progressive. You just need the code to be progressive. So what he could have done is something like, why don't we just raise the regular individual rate to 50%, leave everything else alone? But there's something to be said for the political optics of spreading it out like this. Let Joe talk about the impact, both financial and philosophical, on the Social Security system. But it's, obviously it's just a way, you cannot remove, although President Obama did it with the payroll credit in 2009, you generally cannot remove taxes on the lower end on Social Security, because that's the core of it. And we want to tax rich people more, so this is one way of doing it. So, but there's more to it than just money. Joe, you have any thoughts?
Yeah, I mean, I think that this is a completely unsurprising proposal, and yet completely sort of nonsensical in a lot of ways. It's opportunistic, it's symbolic, it's not really about Social Security ultimately. So the Social Security tax was not really ever designed to do what it's being used to do in this situation, right? Like, the tax was designed to pay, to some degree, at least, for Social Security, which is why it has the cap, which is why the contributions are in some fashion tied to the benefits, which is why, which is why there's a link there. And when you remove the cap on the contributions, but the benefits are still limited, then the link is broken. And that's why a lot of people hate that, right? That's why a lot of conservatives have always objected to removing the cap. And they always say, well, that's crazy, because now you're breaking the link, and now it's just a regular tax. And that's, I think, what the left is saying is like, yeah, it is. It should just be a regular tax. And they have an argument, which I think has some weight to it, which is that we use this like a regular tax anyway. Like, this link is sort of notional. It exists on paper, but in fact, we use the balances in the trust fund to justify running deficits throughout the government anyway. So the link is all sort of a fiction anyway. This is the argument you get from the left. So let's stop pretending like the trust fund balances really mean anything. At other points, the left will say the trust fund balances really do mean something. But in any case, this is all politics. So I think that the fact that they're breaking this link by removing the cap is significant. The fact that they're removing the cap at $400,000 is completely arbitrary. It just, why $400,000? Well, this is the new number, right? The old number used to be $250,000. That's where we decided that people were rich, that if they made more than $250,000 and they were rich. Now that number is $400,000. And if you go read the papers today, you'll find all sorts of arguments about whether that's true or not. There are numerous articles that have been published in the last couple of weeks, and numerous papers and websites that say $400,000 in lots of cities is just a middle-class income, whatever. But that's another political argument. Why are we, where do we decide that we want to start getting punitive in our taxes? And the Biden campaign has decided that number is $400,000.
Well, let me give you a little bit of historical background. Again, I've only read about it in a book. I'm not that old. Where the $250,000 came from was during the Clinton campaign of 1992, Bill's campaign. Everything was millionaires. We're going to tax millionaires. And as we all know, that's millionaire is an exciting term, perhaps less so these days. And remember, the goal back then was deficit reduction. And when they did the numbers, it's like, gee, taxing millionaires doesn't get us that much. So they switched to quarter millionaires. So most people didn't notice, except those making between $250 and $1 million. So that's where the 250 came from. We should keep in mind that already the Medicare tax has no ceiling on it. So this isn't exactly uncharted territory. And we also have a net investment income tax. I think it's 3.8% that reaches up into that stratosphere, I think above 250,000 in that case. But that's only on investment income. So this would be imposing that higher tax on the wage income. So all of our lawyer and accountant friends who I'm sure are all watching this, they would be the prime targets for this. Those making more than $400,000 a year.
I mean, personally, I'm sympathetic to the argument that the linkage here has been broken or was actually sort of fictional for a long time. And as you say, we talk about the Medicare payroll tax like it's the same thing as the Social Security payroll tax. It's never been close to the same thing. It never paid even nearly as much of the bill for Medicare as the Social Security tax paid for Social Security. So the fact that we should never talk about them like they're the same, and it was uncapped, and yet it serves the same sort of political function, which is, the Medicare tax convinces people that Medicare is bought and paid for by them, which it's not. It's paid for out of, general revenues mostly. Social Security is mostly paid for out of the payroll tax. Anyway, apples and oranges, but it's all about the politics. At the end of the day, this is all about politics.
The other way they were chipping at it was they tax Social Security benefits over $25,000, I think it is. So yeah, there's been all of these, all this dancing around. And then on the other, the other thing to mention is when I started working in tax policy, payroll taxes were clean. It was almost like a flat tax. Now, especially with the CARES Act, there's all these payroll tax credits in there and so forth. So the payroll tax is rapidly evolving into a system as complex with all the incentives and gimmicks and so forth all built in there.
So what you're saying, you're saying is it's evolving into a lucrative practice area for tax lawyers.
Well, absolutely. One lawyer was telling me, he goes, 2 years ago, none of us knew anything about payroll taxes. And now you've got to become pretty expert on what is taxable wages and when they're due.
Honestly, no joke. When I taught a tax policy class, which was only like 3 years ago now, I was literally the only person talking about the payroll tax on the tax faculty. Like no one else really talked about it. And now I think everybody's talking about it.
Well, when I worked at the Treasury, nobody talked about it. But the other thing, since I'm the economist, the reason you have to mention this is since so many people don't pay income taxes at the lower end, and so many businesses now in this recession are not paying business taxes, the only way you can provide them incentives short of a refundable credit is to give them payroll tax credit. So there is a economic reason for it.
Okay, gentlemen. Now, before we leave the topic of payroll taxes, one little point. We got to mention President Trump. He's been active in this area too. A while ago, he issued an executive order that created a one-time temporary payroll tax deferral benefit, which was optional on the part of the employer. I don't think the employees really had much to say.
The benefit was for the employee, right?
Okay, the benefit is for the employee, but it seems like the ability to choose it rested with the employer. Right. And lots of employers chose not to take advantage of this. My question is about this. President Trump has always said that he intends it to sort of morph from a deferral benefit to a payroll tax holiday, envisioning that a future Congress on the other side of the election in early 2021 would say, let's just forgive the repayment. Now, that is an interesting concept, and it sort of goes beyond just the narrow confines of payroll taxes, because this was done by executive decree. Other than self-restraint, what is the limit on a president, this president or any future president, saying, I'm going to defer the IRS's collection of a particular tax till who knows when, a year, 2 years, 10 years down the line? What's to prevent that?
Well, one thing that's prevented is the law. You have to declare a disaster area for those provisions to be effective, where the Secretary of Treasury can delay those payments. And so this year, I think it was on March 13th or 18th, the whole nation was declared a national disaster area. So to get legalistic with you about it, they would have to declare another disaster area for that to happen again. But besides that, you mentioned self-restraint. Well,
not a lot of that.
No comment. And then, you know, on the flip side of it, everybody can always promise, I'm going to cut your payroll taxes in January. So that's nothing new either. So it's just a weird combination of a president who wants to provide stimulus before an election, as any president would, and certainly George Bush in '92 wanted to do that, and Congress not going along. So you just push all the executive powers that you have within the limits of the law. And they're pretty limited. It's pretty small potatoes in the grand scale of things. And of course, keep in mind, I imagine almost every employer except the federal government, or the vast majority of employers, except for with the notable exception of the federal government, are not doing this. So it's just not really an issue.
I do think it could create some weird dynamics, though. I mean, you know, let's say that President Trump loses this election and President Biden is in office in January, and all these federal employees have had their taxes deferred, including, let's say, a lot of military members of the military. Is President Biden really going to be prepared to ask these guys for a great big fat check right away? Or is he going to be more inclined to go to Congress and say, hey, let's give our men and women in uniform a break here and make that deferred, those deferrals actually a forgiveness? And if he does that, what about all the rest of those poor schlubs who've been paying payroll taxes in the interim? Do we get that same pay cut? And so I think it creates a weird dynamic. It's not so easy for him to ask for them to make that, to ask a sympathetic group of people to make that payment, which is going to be a pretty difficult payment to make. And at the same time, it's you know, it's a lot of money to get back. Now, maybe that'll just be a way that they'll grant stimulus, you know, that they'll frame the stimulus. That could be.
And everything Joe said is true, but he even simplified it. As complicated as it was, he even simplified it, because in the case of the federal government, the government's the employer as well as the tax. So the government could either supplement the wages to make up for it, or could give the taxes. For the poor schleps who are caught in the middle here, either the employer could just eat it, or the employer can go, you owe it all today, or probably, you know, guidance will probably have to be issued. And then the other thing is, hey, I was working, you know, before Christmas, but I'm gone now. So they can't find the people.
Yeah, no, it's a mess.
So it is just a nightmare of ridiculous possibilities, technical, philosophical, legal, blah.
Bad idea.
Guys, it's that part of the show where we're going to talk about capital gains. Now, we could fill a whole program with this. Does this category of income merit a rate preference relative to ordinary income? And why would you do that? For the sake of incentivizing innovation and entrepreneurship and things that your economy arguably needs. To look at what's actually in the Biden plan, he's proposing that you would have rate parity between ordinary income and capital gains, but only for those with taxable income over $1 million a year. So a different threshold, not the $400,000 we were talking before for the top marginal rate for the individual income tax, but $1 million for rate parity for capital gains. Marty, I'll swing it to you. Good idea, bad idea?
Let me compress it down into three or four quick points. One is economically, all capital income should be exempt from tax in the ideal tax system. So there's always an argument, a strong economic argument for repealing any tax on capital income. Why capital gains in particular? There's really not a good reason, except that inflationary gains really aren't true economic income. So those are two pretty strong arguments for not taxing capital gains or giving them a preferential rate or indexing them, some people. Indexing would be a very complicated, and you really have to index the whole tax system to make it work properly. Okay, having said that, what is overwhelmingly true is the reason why very wealthy people, I'm talking billionaires, don't pay so much tax is that they have extremely favorable capital gains tax rates, and particularly if they die. So where they don't have to pay any capital gains rate. So you could take an example of an individual, let's call him Bill Gates, who makes $100 billion in his lifetime. Most of it is appreciated Microsoft stock. And by the way, I don't know about the particular situation. I'm just using him as a faux example. But it is conceivable, if he receives no salary and he never sells that stock and donates it to his children, that they never pay any tax on one of the greatest fortunes in the history of the world. So now to the extent he gives to charity, those taxes would be reduced, et cetera. But that is a major loophole. It is the loophole for the super wealthy, which most population doesn't even know about. The other thing is this $1 million threshold. When you're a capital gains type of person, you're making 2 million one year and you're losing 500,000 the next year and you're making 10 million the next year. This is going to require all types of averaging and gaming and income shifting. So it is not the most pleasant proposal, no matter how much you agree with it in terms of enforcement. So that's just a few comments.
Joe, I'd like an observation from you about what I see as the stickiness of this rate preference. I mean, correct me if I'm wrong, but it seems that even during periods when the Democrats controlled government, this preference, I mean, they may have adjusted it or tweaked it here and there, but it didn't seem to go away. So what does that tell us? Is there really a constituency for rate parity across the board?
Well, there's a constituency for it, but that constituency might not be in Congress, I think. I think you're right. So it has the rate differential has disappeared a couple of times, but
in
only
1986.
Right, and then again, like around 2000, briefly. I'd forgotten this, and it was recently pointed out to me, but briefly for like a year. But the answer is that with a couple of exceptions, it has existed across time, and that even if we look back and we think about the great moments of progressive taxation, of soak the rich taxation, right, when we really went after the rich guys as hard as we could. So Franklin Roosevelt, right, he actually did not like the capital gains rate preference. He also couldn't get rid of it. So I think that those who want to get rid of it need to know that they are pushing hard against something that is pretty hard to get rid of.
And in the trenches, but extremely important factor in the legislative process is the revenue estimating process. And when you reduce the capital gains rate, people stop, when you raise the capital gains rate, people stop realizing gains. So the revenue estimates inside the revenue window are very small. So you can have these tremendous fights over this. And then the members of Congress look at the revenue table and say, oh, we're only gaining $5 billion. Go ahead and, forget about it. So usually in the end, that's what happens, is it's just not worth the trouble for the amount of revenue that you're raising.
I think that's right. It's not really about, ultimately, it's not a revenue argument. I think that the politics of it turns on the people who actually end up paying the tax. And they actually tend to be pretty well connected, and they manage to hold on to it. And then I think, the bigger issue here is the one that Marty alluded to, which is that it creates some vast disparities in the amount of tax paid by different people, and that is mostly unnoticed by the general public, I suspect. But when it's brought to the attention of the general public, it does not go down well. So, when you do see polling that says, hey, rich people are not paying their fair share, what those people are mostly reacting to is the capital gains rate preference. And they don't know it, but that's really what's driving it. And that one of these days, it's possible that someone will harness that discontent effectively, and that will make it for a change in the rate preference. Because I think that this is a problem. It is a problem when you depend on public consent to make a tax system work. This is the source of a lot of discontent. And if it's mobilized in the right way, it will really be a problem for the tax system. So just something to keep in mind, I think.
Yeah. And the don't forget one little slice of the capital gains debate is the carried interest debate. But as long as Senator Schumer is Senator Schumer, I don't think we're going to have much movement on that point. The other one that's lurking in the background, again, most regular humans don't understand this, but there are things called like-kind exchanges, which are extremely valuable to the real estate industry. And these are on Vice President Biden's radar. And if there was a Democratic sweep, I wouldn't be surprised if it would just, believe me, the real estate community will go ballistic. But it would be up there.
Okay, I'd like to shift gears here and talk a little bit about itemized deductions. If elected, Joe Biden claims that he would cap the value of itemized deductions at about 28%, but he would only do that for people over a certain income level, again, $400,000. I guess the first thing to say about itemized deductions is that they're not what they used to be after TCJA. After we had the modifications to the state and local deductions, I think the evidence is there that we see.
And the increase in the standard deduction.
Yeah, and the increase combined with the increase in the standard deduction, we see far fewer households taking the itemized deduction. Now, in one sense, that's not the worst thing in the world, because whenever you have a lot of people using itemized deductions, there are implications for the progressivity of the whole tax code. But let's try to just focus here on the Biden proposal. Marty, Sullivan, what do you think of capping the value of itemized deductions as opposed to just getting rid of them and saying, you've got a standard deduction, use that?
Well, I think many tax reform proposals in the past have said, gee, it ain't fair that Bob, you wealthy person, you get 35% when you donate to your favorite museum, while me, I only get 24% on my donation. So it's a way of leveling off it's making those deductions more fair. The best fairness method would move all of them to credit. So it's sort of a halfway, it's making the distribution, the value of these incentives more even. But the other thing, and I think the main thing here, is going after the wealthy. That's the $400,000 cap. It's not across the board. It's just for the 400.
And what do you think Biden would do if elected about state and local? What's the prevailing view?
He's going to get rid of the TCJA. Put a limit of $10,000 on deductibility of state and local taxes, which affects blue states extremely disproportionately relative to red states. It's in the HEROES Act. It's in his plan. The HEROES Act is the Democratic plan, stimulus plan. So it almost certainly would be eliminated. The cap would be eliminated.
Joe, would that be a prudent thing to do?
I mean, this is raw politics, right? I mean, it's been raw politics since it was, for decades. They've talked about this kind of a cap on the deduction or eliminating it entirely for decades. It's always been framed as a red state, blue state sort of thing. They finally got it over the line in 2017. And it doesn't really surprise me that Democrats are going to walk it back. It's hard to defend walking it back, even using the Democrats' own preference for progressive taxation. It's hard / impossible to defend. But it's not about that. Ultimately, like many things in politics, it's about politics. And so, what can I do? I smile wryly and say, well, yeah, it's bad politics to walk this back. But they're going to do it anyway. I mean, it's bad tax policy to walk this back, but they're going to do it anyway. What I would say to flip that around, so I'm calling the Democrats whatever, soulless or or hopelessly political. What I also think is it shows you that when you enact a tax reform bill that is without bipartisan support, that it's going to be undone as soon as the politics are reversed, and they're going to undo the good parts along with the bad parts. And so that's an argument against trying to do meaningful tax reform in a partisan fashion. If you want it to stick around, you got to do it in bipartisan fashion, or you're going to lose it all, good and bad. So,
that's a warning to both sides, because the Recovery Act in 2009 passed almost entirely, like 99.9% on partisan lines. The TCJA similarly. And if we had a Democratic sweep, we'd go back to the another. And, we're just figuring out the TCJA when the CARES Act came in and scrambled that up. And now if we had another bill, and we haven't even talked about the international provisions yet, it is on top of BEPS changes. It is really quite astounding how large the changes are, and what people who aren't in the weeds on this, how they are incredibly complex, almost just incomprehensible and uncomputably complex. That's how bad it is. But, they're multinational corporations, they'll survive.
And some things are hard to unwind, right? And then they don't get unwound, right? So, for all the talk about, just to choose something non-taxy, the ACA, unwinding the ACA would be monumentally difficult at this point, right? Because it's been incorporated into the way that the healthcare system works. And I think there are probably elements of the TCJA that may be like that too, that when the Democrats get up close to it and look at it, they're going to say, well, actually, this might be kind of hard to do to try to unwind this completely. So there are ways in which policy, even politicized partisan policy, sort of embeds itself in the world that makes it difficult to just take apart. I think we'll find that's true to some degree.
Joe
about
makes
parts
an
of the TCJA.
excellent point. In 2012, when we reached remember the fiscal cliff, and what did Obama do? Did he repeal the Bush tax cuts? No, he only repealed them for the upper bracket. So it's very hard to, once somebody gives something away that people like, it's hard to take it back. So we kind of had this ratcheting downward effect. For example, on the small business deduction, Section 199A, for all you techies out there, Vice President Biden wants to eliminate it, but only for people over 400,000. So, you want to, you just keep whittling down, but leaving the parts you want to leave. It's very hard to take away popular items that are massively, popular across the spectrum.
Well, I'd like to talk about the corporate side now. We've talked a lot about individuals. On the corporate side, we have a headline rate. It's currently 21%. If elected, Biden would increase it to 28%. And well, Marty, when you hear that rate, 28%, the first thing you think about is that it's not 35. Is that some sort of a very subtle implied victory for all these friends of ours who've been going around for the last however many years talking about rate competition and how 35% was just crazy uncompetitive, too high, highest corporate tax rate in the world?
No, it is. It is absolutely a recognition that in this world you can't have a rate above 30%. And some say you shouldn't have one much above 20%. But I think, absolutely, I've said it for many years. the corporate rate had to come down, and the Democrats were just being too stubborn on that point. Actually, Bush two was being stubborn on that point. He had a Republican House and Senate, and he was in the White House, of course, and he did not lower the corporate rate. There was political fear of reducing the corporate rate, so he focused on the individual side. And by the way to get to 28% is 35 minus 21 is 14. Divide that by 2 is 7. Add 7 to 21, you get to 28. It's just halfway in between. There's no science to this stuff.
But 28% is higher than the OECD average, which roughly reflects, our peer nations or our trade partners.
Well, if you look at that average, you notice that the larger, more powerful companies have higher rates and the smaller companies have lower rates, which sort of makes sense because larger companies have more power to attract people. So I think it's within the range of reasonableness. And of course, as we know, it's not just the rate that matters.
Of course.
Things.
Any conversation of statutory rates really sort of misses the point. There's also a Sur Tax that he has, a 10% Sur Tax, which would bump the effective rate up beyond 28%. And he says it would apply to companies that offshore US jobs and then turn around and sell the products they produce back to American purchasers, a sort of round tripping Sur Tax.
Well, unless Joe has something to say, I'll say something about this.
Take it away.
Which is, these round tripping proposals have been around a long time. And the latest version is actually into law in the foreign derived intangible investment income. You can't track what stuff comes in. You have supply chains that could be in, out, in, out, in, out. What's an import? What's an export? These are impossible to do. I've seen them for at least 20 years. They make great political headlines. You shouldn't get a tax break for building something overseas and then bringing it back into the United States. But those are really untenable. And if they are enacted, like FDII right now is just a mess and doesn't really work the way it was stated to. So I think that's small potatoes. I don't think that's going anywhere. And I think what's much more important are two other international provisions, which I'm going to make you talk about if you don't get to it.
Well, my next question is about the GILTI provisions, because they're GILTI is global intangible low taxed income, and we're not even going to get into the OECD and the pillars and stuff like that. But this was one of the main base broadeners that emerged from TCJA when they transitioned from the deferral repatriation based system to the participation exemption we have now. And actually, that's my first question, Marty, about Biden's proposal. Deferral is gone. The lockout effect is gone.
Very good.
He keeps the participation exemption. So, I was really curious. If you really are serious about unwinding TCJA, you might try to maybe put a bullseye on the target on the back of the participation exemption. But once you've designed a territorial system and moved away from what we had before, it almost makes no sense to go back to it, just because the transitional costs, it seems, would be alarming. What do you make of the fact that Biden would retain territoriality?
I would say he is not retaining. In effect, he is not retaining territoriality. And the way the GILTI works is, in the United States you pay 21%, and I'm simplifying, of course. Mm-hmm. In the United States you pay 21%. In offshore you pay 10.5% on your foreign profits. What Biden would do is raise that rate to 21%, and there was an exemption for a little slice called QBI. He would get rid of that. And also he would count, and this is a little technical, but the folks who know about it, it makes a big difference. He would do it on a country by country basis. So basically, I don't know why he isn't just saying we're going back to a worldwide system. Maybe he likes the fact of saying, well, we're taking the Republican proposal and we're just tweaking it. But these tweaks, in effect, mean all foreign profits of U.S. multinationals will be taxed at a full 21% rate with the availability of foreign tax credits.
It's time to get to our final question, and this one is for Joe. And it doesn't necessarily have to do with either candidate's tax plans. It has to do with our societal perceptions of tax fairness. As you know, there have been these New York Times stories about President Trump's taxes and whether he's been paying enough taxes and so forth. You recently wrote that what's been reported by the Times, that for some years he only paid 750 taxes, that number is actually more difficult to justify before the public than saying you paid no taxes at all. Again, for reasons that go to societal factors about how we feel about fairness. Could you elaborate on maybe why $750 is a harder number to justify than zero?
Well, it's just so memorable, right? I mean, it's so ostentatiously small. I think that this is almost this moves into the realm of PR and out of the realm and whatever the intersection of PR and politics is. But I've always thought that the zero payments were a problem for politicians, and I've written articles that made that argument too. But I think that President Trump at least had more or less tackled that issue during the 2016 election, when people had floated the idea that he hadn't paid any taxes, and he had almost admitted as much during some of the during the 2016 debates. He'd said, that makes me smart, when Hillary Clinton accused him of that. But I think that $750 just puts it in sort of sharp relief. And so,
Joe, am I correct that he did it 750 in 2 years? It's quite a coincidence.
It's $750 in 2 years. And actually, when the Times and the New York Times tried to do the math on it, there really is no math on it. That he actually had zero tax liability, and they just sort of randomly chose $750 in non-liability, that $750 payment that he didn't actually owe. And that's not unprecedented, incidentally. Other presidents have made payments at tax time that they didn't actually owe. Jimmy Carter made a voluntary payment to the Treasury that he didn't owe because he felt like it was bad to make no payment at all. But Jimmy Carter made a payment equal to 15% of his adjusted gross income, which was a sort of reasonable number based on what the alternative minimum tax was at the time. But Donald Trump paid $750, which was sort of a number sort of plucked out of nowhere. So I think, if you look at what the news coverage was of the news coverage, right? The story is written about the New York Times story. They all harped on that $750 number. And I think what it really says is that was a real ham-fisted effort to try to protect the president so that he could say that he had paid something. Well, I think that was badly conceived. But it's just, so much of presidents and the taxes they pay is about symbolism. And this was some pretty bad symbolism. And that, brings up larger questions of why we care about whether presidents pay their taxes and how much they pay in taxes and whether we should care about that at all. But I think that, the thing here that was so clear is that there was an assumption that built into this that Americans do care and that this would somehow take care of that. And I think that was kind of clearly mistaken.
And let me just add that there are many businesses and many corporations and many individuals that don't pay any taxes. There are three reasons why they may not pay taxes. One is they had real economic losses. No harm, no foul. The other is they may have just had a lot of tax breaks that the dear old Congress gave to them. Is that really their fault? And the third is maybe they've been a little bit too aggressive in their assertions and valuations and so forth. And it's really that third category which is problematic. So we want to be careful not to go, oh, you paid no taxes, you're a terrible person. One major category of non-tax paying millionaires are individuals who invest entirely in tax-exempt bonds. And if you think about it for a minute, I'm going to try to explain it now. There's really no harm in that. So you want to just be careful. I'm not trying to exonerate what Mr. Trump did or condemn him either. But I just want to point out, just because somebody pays zero taxes is not necessarily an evil thing. Although, as Joe says, it's
Mhm.
not good public relations.
No, and the truth is, we still, even now, don't know exactly what was going on in those tax returns. We haven't seen the actual tax returns. The Times has described some things about them, but has actually not described all that much in some ways. And so we don't really know. And you know, Marty sketched out these three possibilities. I've heard other people put those in less polite terms. He's either a terrible businessman or a terrible tax cheat or both. But it easily could be a mixture of all those things, right? He could have had real, genuine losses. He could have been exploiting things that are deliberately included in the tax code. Yeah, it could have been a lot of those things combined. It probably was a lot of those things combined. But we don't actually know at the end of the day, and we may never know. Because my guess is the president is never going to release his tax returns unless he is actually prosecuted in a court of law for some tax crime. We will probably never know. So, you know, I don't fault the New York Times for the way that they got this information or what they did with it. I think they're just doing good journalism. I've said this in other tax analysts podcasts or whatnot. I think that this is not the way we want to get presidential tax records into the public record. Leaks are not the right way.
It's against the law.
It is against the law, but it's not against the law for the New York Times, I don't think, to do what they did, but it's against the law for the person who did the leaking to do what they did. Probably, we don't actually know who leaked it. I mean, could have been leaked by the White House for all we know, right? Like, we actually don't know anything, right? We know nothing. It could have been leaked by his wife. Like, we don't know anything.
We will have to leave it there. It's time to wrap. Gentlemen, thank you for your opinions. Thank you for joining us. And we look forward to the election just around the corner. Maybe we'll do one of these programs on the flip side of the election and make sense of the picture then.
Just don't play back our predictions.
Absolutely.
Yeah, right. That
not.
would be mean.
Thanks
Thank you,
again.
Bob. Thank you, Joe.
Thank you, guys. Bye-bye.